Welcome to the Deep Dive, your shortcut to staying informed. Today, we're digging into HCA Healthcare's Q3 2025 earnings call. HCA, of course, being the largest hospital operator in the U.S.
That's right. And our goal here is really to unpack what happened, because you've got this real tension, right? Strong operational results on one hand.
Really strong.
But then this kind of shadow hanging over everything, which is all about federal policy risk.
Exactly. So let's start with the good news, the headline numbers. It was genuinely impressive.
It really was. A clean double beat on earnings, beat on revenue, and they raised guidance. Can't ask for much more on the surface.
Okay, give us the specifics. What was that EPS number?
So the GAAP diluted EPS adjusted came in at $6.96. The consensus was looking for something like $5.72.
Wow. Okay, so that's a massive beat, over 20%.
Yeah, a substantial 22% beat there. Really turned heads.
And the top line, revenue must have been strong too.
It was $19.161 billion. That was about $600 million better than the street expected. Represents 9.6% growth year over year. Very solid.
And that flowed through nicely. Adjusted EBITDA.
Yep. $3.87 billion. That's an 18.5% jump compared to last year, and kept the margin strong at 20.2%. So operationally firing on all cylinders.
Okay, so you've got this blowout quarter, right? Double beat, guidance raise. Why didn't the stock hold on to its gains? I mean, it opened strong, up nearly 4%.
It did, yeah. Even touched almost 5% up at one point.
But then it just sort of fizzled out, way closer to flat. What gives? Is it just sell the news?
I think it's more than that. That intraday selling, it signals that investors, they digest the good news very quickly and immediately pivoted to the risks.
The policy risks we mentioned.
Exactly. They started discounting the source of some of that strength, realizing how much relies on political decisions, particularly around insurance coverage and supplemental payments. So the question became less about did HCA have a good Q3 and more about how sustainable is this really high margin payer mix going into 2026?
Right. It's pricing in that uncertainty. So let's dig into why the quarter was so strong operationally. You don't get a revenue beat like that without serious demand. Where did it come from?
Well, the demand was pretty broad-based, actually. If you look at same facility equivalent admissions, they were up 2.4% year over year.
Okay.
And same facility actual admissions up 2.1%. But here's the kicker. Revenue per equivalent admission jumped 6.6%. That's a huge increase.
6.6%. Okay, so that tells you it wasn't just more patients. It was, let's say, better patients from a reimbursement perspective or higher acuity cases.
Precisely. It points directly to a really favorable shift in payer mix and probably higher acuity, more complex procedures being done, which loops right back to that policy risk question.
Because those high reimbursing patients are often the ones whose coverage might be affected by policy changes, right? Like ACA subsidies.
Exactly. That's the paradox. The strength itself highlights the vulnerability. Looking at the mix, total commercial equivalent admissions grew 3.7%. And crucially, within that, commercial exchange volumes, the marketplace plans, they jumped 8%.
8%?
Yeah. And Medicare equivalent admissions were also strong, up 3.4%. So you see growth concentrated in the better paying categories.
So basically, people with good private insurance or Medicare, especially those on the ACA exchanges, were driving the bus.
Correct. And on the flip side, Medicaid admissions were down and self-pay admissions dropped 6%. So you swap out lower paying visits for higher paying ones, and boom, your revenue per visit metric shoots up like that 6.6%.
And what kind of services were driving this? Surgery.
Yeah, definitely seeing strength in surgery. On the inpatient side, they called out neurosciences, orthopedics, and cardiac surgical areas.
High-end stuff.
Very much so. And outpatient was also strong, particularly urology and general surgery. It's the complex, higher margin procedures that really fueled the quarter's outperformance.
Okay, strong volumes, great mix. But that often comes with cost pressures, especially labor. Did they manage costs well?
They really did. This was another highlight. Management pointed out that contract labor, the expensive temporary staff, was basically flat compared to last year.
Flat? That's impressive given the volume growth.
It is. And it now represents just 4.2% of their total labor cost.
Yeah.
That shows really disciplined operations, getting a handle on labor expenses post-pandemic, maybe better than some others.
And that discipline showed up in cash flow.
Absolutely. Operating cash flow is very strong at $4.416 billion for the quarter. So the operational strength wasn't just on paper, it was generating real cash.
Which must have given them the confidence for that guidance raise you mentioned. Let's talk about those updated numbers for the full year 2025.
Right. So they bumped up the revenue forecast now expecting $75.0 billion to $76.5 billion. That midpoint lift is pretty chunky, about $750 million higher.
Okay, and earnings?
Diluted EPS guidance raised to $27 to $28. Adjusted EBITDA now expected between $15.25 billion and $15.65 billion.
And they're still planning to spend big on expansion.
Yep, they reiterated their capital expenditure plan at around $5 billion for the year. So they're still investing heavily despite the uncertainties.
Okay, $750 million lift to the revenue midpoint. That's significant. Now, we have to tackle the elephant in the room.
Yeah.
Those Medicaid supplemental payments. How much of this strength and this guidance raise is tied to those potentially less stable payments?
This is really where you need to parse the details carefully. Management was quite clear. Those supplemental programs drove about half of that big 6.6% jump in revenue per equivalent admission.
Half. Okay, that's a lot.
It is. And the net benefit to adjusted EBITDA just from these programs in Q3 alone was roughly $240 million higher than last year, mostly driven by payments kicking in Tennessee and also approvals in Kansas and Texas.
And why are these seen as, well, risky or less durable?
Because they often rely on specific state and federal agreements, waivers, or program structures that aren't necessarily permanent. They can change with budgets or policy shifts. They're great when they come through, but they aren't the same as, say, pure volume growth from your core commercial business.
Got it. So what's baked into the new guidance regarding these payments?
The updated full-year guidance now assumes a net benefit from these programs of about $250 million to $350 million more than they got in 2024. But, and this is important, that guidance doesn't include any potential upside from other applications that are still pending review. They mentioned states like Florida, Georgia, Virginia have programs sort of in the queue.
So they're only counting what's basically approved or highly certain, no speculative policy wins baked in.
Exactly. They're being cautious there, telling us, look, this is what we expect based on current approvals. Maybe there's more, but we're not banking on it yet.
That caution makes sense, especially when you connect it to the biggest policy question, the Affordable Care Act, specifically the premium tax credits. CEO Hazen seemed quite focused on that during the call.
He absolutely was. They're clearly advocating strongly for Congress to extend those subsidies, which, as he noted, help cover 24 million Americans, many of whom are likely showing up in that strong commercial exchange volume HCA reported.
So the uncertainty there is massive.
Yes, huge. So much so that management basically said they can't give meaningful, detailed financial guidance for 2026 yet. They're sticking to broad strokes, expecting long-term volume growth, maybe in the 2-3% range, stable cost trends, but the full picture, they need clarity from Washington first.
Which leads to an interesting potential side effect. We've heard some talk, maybe from managed care companies too, that this very uncertainty could actually pull some demand forward. What's the thinking there?
It's this idea of a pull-forward effect. Basically, patients who have good coverage now, maybe through those exchange plans, and are worried they might lose it or face way higher deductibles next year. They might decide, hey, I need that knee replacement, or I should get that cardiac procedure done now while I know I'm covered well. So they might rush to schedule elective procedures in Q4 this year, or maybe very early Q1 next year, before potential disruption hits.
Ah, okay. So the policy risk ironically creates a potential near-term volume surge. Makes sense.
Could happen. It's a behavioral finance kind of thing.
Meanwhile, HCA isn't just waiting around. You mentioned the $5 billion in CapEx. What's the strategic focus there?
It's really about building long-term resilience and staying ahead. A lot of it is expanding capacity, building out more outpatient facilities to meet patients where they are.
Makes sense.
And a big piece is technology. They talked about investing in advanced digital tools, using AI in workflows, things aimed at improving hospital throughput, making documentation easier for clinicians, boosting productivity. It's about embedding efficiency deeper into their operations.
Right, that sort of resiliency culture they talk about. And quickly, there was also a note about hurricane recovery impacting Q4.
Yes, a bit of a tailwind expected there. They anticipate about $100 million in year-over-year adjusted EBITDA growth, just from markets bouncing back from hurricanes that hit in 2024. They expect all of that recovery benefit to land in the fourth quarter.
Okay. And just to round out the picture, management basically put their 2026 capital allocation plans, buybacks, dividends, future CapEx on hold, pending that policy clarity, right?
That's correct. They confirmed the discipline continues, but they're not ready to lay out the 2026 plan until they have a better handle on what the federal policy landscape, particularly around the ACA, will look like. It impacts their revenue potential too much to commit prematurely.
Very prudent. Okay, that brings us to our, let's call it our thought experiment segment. And the usual, very important reminder first.
Absolutely. Nothing we discuss here is financial advice. It's purely informational, synthesizing the call data. Always do your own homework. Consult with professionals.
This is just us kicking around ideas based on the dynamics we've discussed.
Connecting the dots, if you will.
Okay. So, given everything, the strong Q3, the guidance raise, that heavy reliance on commercial volume, especially exchange volume, and this massive ACA subsidy risk hanging out there, what's a potential tactical play?
Well, building on that pull forward idea we just discussed, you could frame a short-term tactical trade. Maybe thinking about a long position, perhaps using something like near-term call options, not necessarily on HCA itself, but on companies really leveraged to elective surgical demand.
Targeting those high acuity procedures, ortho, cardiac, neuro.
Exactly. The bet wouldn't be on HCA's fundamental long-term growth trajectory, but purely on the timing aspect driven by patient behavior reacting to policy uncertainty.
So you're betting that patient anxiety about losing coverage in 2026 pushes a bunch of profitable surgeries into Q4 2025 and maybe early Q1 2026.
Precisely. It's a trade based on a potential short-term demand spike fueled by external political factors, captured by companies operationally ready for it, like HCA likely would be. Highly tactical, depends entirely on that patient behavior playing out.
Interesting. A very specific timing-dependent idea. Okay, let's wrap this up. Key takeaways from HCA's Q3.
Fundamentally a very strong quarter, great execution on volume, really benefited from a favorable payer mix, partly policy-assisted, and good cost control, all translating into that confident guidance raise for the rest of 2025.
But
the giant asterisk is 2026 and beyond. The question for you, the listener, to really ponder is this. Is HCA's impressive scale, their network, their investments in efficiency and AI, is all that enough to completely navigate or offset the significant policy storm clouds gathering over their crucial commercial payer mix?
especially regarding those ACA subsidies.
Exactly. That outcome is probably the single most important variable for HCA's performance trajectory heading into next year. Keep a very close eye on developments out of Washington.
Excellent point to end on. Great insights today.
Good discussion. Thanks for listening, everyone.
And just one final reminder, this was for informational purposes only. Please do your own research before making any decisions. We'll catch you on the next deep dive.